Business News now. Ed Boyd joins us. Ed, good morning. Quarterly inflation numbers released this morning. The CPI index could fall to 6.2%, 6.1% core measure, according to Tom Petrovsky today. That's the one we're all looking at.
That's the one that we're looking at, and more importantly, Pete, that's the one the Reserve Bank looks at, because remember, their next cash rate decision is just on Tuesday, so that's coming up really soon. They would have seen the unemployment numbers last week showing an unemployment at 3.5%, and now the inflation figures as well. So we got the forecast we can put up on the screens. There's a few different figures. So there's the annual rate there, going down from 7% in the previous quarter. The expectation is the June quarter will be 6.2%. And then we've got the monthly inflation indicator as well. So the monthly indicator is a little bit lower, down at 5.5%. Here's what inflation's done over the past roughly year and a half. And you can see big peak at 8.4% in December last year. And it is slowly coming down, but I still don't think it's coming down quickly enough for the Reserve Bank. But today, look out for petrol prices being cheaper and fruit and vegetable prices being cheaper as well. Those are the two main things.
So for the folks at home, and a lot of this goes over their heads, right, Ed? So if it's above, let's put it at about 6.1, 6.2. If it's above that, does that mean it's very likely RBA will raise interest rates? If it's below that, then it'll probably press pause. Is it that simple?
I think it's pretty much that simple. I mean, that's really what we're looking at here. If inflation prints higher, the Reserve Bank's going to go, all right, prices aren't coming down quick enough. The economy's still slowing. We need to put more brakes on the economy. People are still spending money, basically. If inflation goes up a lot more than expected, people are spending money at the checkout. They're not getting concerned about interest rates. The Reserve Bank wants people putting that money not into retail stores. They want them putting it on mortgages to bring down inflation. And that's happened in other countries around the world, particularly the US, where inflation's now at about 3%. But here, it's almost double that at, 6.1%.
Okay, tomorrow the US Fed Reserve announces its cash rate decision. Rates likely to jump above 5% there, Ed.
Well, this is the thing. So inflation at 3% in the US, they're still not happy with inflation being at that level. They want to bring it down even lower. So we're going to hear from Jerome Powell, the head of the US Federal Reserve, tomorrow morning. He does his press conference about 4 or 5 a.m. Australia time. And he's expected to lift interest rates again. So the cash rate in America is at 5%. It's probably going to go to 5.25% tomorrow morning. And it's really a sign that over there, at least, that they're coming to the end of their cash rate rises. So it could be one of the last cash rate increases for the American economy for quite a long period of time before they start to cut rates as well.
Okay, and global wheat prices, they've kept on rising this week, Ed, after Russia bombed some Ukrainian wheat silos in the Danube River.
Yeah, that's right. So remember, they bombed the port of Odessa, basically preventing Ukraine from exporting grain across the Black Sea. So Ukraine have now been using the Danube River, and that's actually been 60% of their exports go through the Danube River and go over trucks across Europe. Now Russia have started bombing facilities on the Danube River. So we can put up the wheat futures chart, which we've got, basically showing the wheat price in the last 7 days. You can see it was up 18% yesterday. It's now come back a little bit, but still up 14%. So this is really showing just how much of an impact the Ukrainian market has on wheat prices in general.
Okay. Ed Boyd, good to see you. Thank you. And Ed will be back with us throughout the course of the day as we get closer to those CPI numbers. Thank you, Ed. Talk to you soon.